Welcome to the Deep Dive. We're here to explore really interesting documents and pull out the kind of a strategic thinking that helps you stay truly informed.
And today, we've got something pretty special.
We really do. We're diving into the Markel Group's 2001 Shareholder Letter. Now, I know what you might be thinking. Oh, a corporate report, but hold on.
Yeah, this is definitely not your typical dry financial summary.
Not at all.
Yeah.
It's actually a fascinating window into how a company deals with, well, unprecedented challenges.
Yeah.
It's like a masterclass in resilience, in transparency, written right after a major global crisis.
Right, and our mission here really is to unpack that, to pull out those key insights about, resilience, discipline, that long-term perspective, especially from a year that, well, it literally shook the world.
So what are we working with?
We've got the letter itself, and it's a really rich text and some guiding questions we've put together just to help us explore why it still matters and how maybe, we can apply some of its lessons.
Absolutely.
Yeah.
Because you really need the context, don't you, to appreciate just how remarkable this letter is. We have to remember 2001.
Yeah.
A year defined, tragically, by September 11th. This letter wasn't written in some, calm period. It was crafted right in the middle of that shock.
The world was reeling.
Exactly.
Yeah.
The economy, industries trying to figure out what just happened. So it's way more than just a business review. It's really a testament to navigating chaos. Post right when everyone was scrambling. Pretty amazing, actually.
A very unique piece of corporate communication, written under immense pressure.
Okay, so let's tackle the big thing first. The immediate direct impact of 9/11 on Markel. The letter is incredibly upfront about it, almost startlingly so.
It really is. They don't pull any punches.
No, they lay out the specific financial costs.
Right.
It was $109 million in losses tied directly to 9/11.
And that breaks down how.
So $75 million was straight from the World Trade Center losses. And then there was another $29 million from what they call adverse loss development in a North American program.
Right. And maybe we should quickly explain the adverse loss development bit for listeners. It's not like a totally new loss that just happened.
Good point.
It means they had to go back and significantly increase their estimates for claims that had already happened. So it reflects a more cautious view, maybe a more realistic view of what those claims would ultimately cost.
Which really shows that conservative approach in action, right? Even when the news is bad.
Exactly. But, as the letter points out, it was about much more than just the money.
Oh, yeah.
It talks about the huge loss of human life, the wider economic damage, and even just how it affected people's basic sense of security.
That human touch, even in a financial report,
Yeah.
it really does stand out.
It does. And what's compelling is how this crisis links straight back to Markel's identity. The letter points to their, 72-year history at that point, and emphasizes that it was built on conservative accounting, conservative reserving methods.
So that history, that foundation, wasn't just talk. It was like their armor.
Precisely. That long-standing approach, the conservative reserving, meant they weren't, caught completely off guard. When the WTC losses hit, obviously a massive, painful blow, they had that financial cushion already in place.
So they could absorb it.
They could absorb it without sort of mortgaging their future. It wasn't a last-minute panic. It was the result of decades of disciplined financial management, real preparedness.
So they acknowledged the disappointments of 2001, and there were definitely some big ones.
Oh, absolutely. But they also highlight positive developments, things like integrating their international businesses successfully.
Right, and making progress in London, getting good pricing on new business almost everywhere.
Yeah, so even though they call it a difficult and disappointing year, their own words there was a strong underlying progress happening in key areas.
Which just makes you wonder, how does a company like Markel actually manage that? How do you find your feet, let alone grow, when everything feels so unstable?
That's the core question, isn't it?
How do you strategize when the world's in turmoil? Okay, let's shift gears a bit and look at the engine room, Markel's core insurance operations. Because despite everything, the top-line growth is kind of amazing.
It really is.
Revenues jumped 28%, went from $1.1 billion up to $1.4 billion. That's a huge leap for such a tough year.
Yeah, that growth figure isn't just a number, is it? It shows they were making strategic moves even while the world seemed to be hitting the brakes.
But as you'd expect, it wasn't all positive news under the hood.
No, definitely not. When you break down the performance by segment, you see this really interesting mix of, challenges, but also underlying strengths.
So let's start with North America. What did that look like?
Okay, North America. They wrote $1.2 billion in premiums.
Yeah.
But The overall combined ratio was 124%.
And maybe just quickly, for anyone less familiar with insurance talk, 124% combined ratio. That means for every dollar in premium they collected in North America, they paid out $1.24 in claims and expenses.
Exactly. Which clearly signals pretty significant underwriting losses. Yeah. But it's in moments like these tough times, that you really see Markel's discipline. They didn't panic, didn't start chasing risky business for short-term gains.
No, what did they do?
Well, the letter stresses the absolute need to increase reserves, to double down on those conservative practices they built their name on, even though it hurt the immediate bottom line.
So, specifics. How bad were the losses?
Total underwriting losses for the year were $294 million. That included $29 million from a North American contractors program they actually discontinued.
So they were cutting bait on things that weren't working.
Precisely. But it wasn't all bad news there either. They had bright spots. Specialty underwriting had a strong year. Their Essex E&S unit, that's excess and surplus lines, covering unique or high-risk stuff standard insurers avoid. And their professional and products liability units did really well. They even mentioned the Southwest operation was expected to turn profitable soon. And overall, the underlying underwriting actually improved. If you strip out the WTC impact and those discontinued lines, the North American combined ratio was much better, around 99%.
Okay, so North America faced serious headwinds, but also showed some tactical strength and discipline. How did things look internationally, especially given the global nature of the 9/11 impact? Was it a different story?
That's a great question. International had its own set of challenges, for sure. Gross written premiums were $716 million, earned premiums $468 million, but the combined ratio was 134%.
Oof, even higher than North America.
Yeah, and no surprise, the World Trade Center loss was the single biggest factor there. But they also flagged something else, $20 million in much higher costs just to renew their marine and energy reinsurance treaties for 2002.
And reinsurance, just to clarify, that's basically insurance for insurance companies, right? Helping them handle really big or specialized claims.
Exactly. They transfer some of their risks. So seeing those costs jump so high tells you just how much the whole market reacted to 9/11. The ripples were massive.
Makes sense.
But here's where that long-term view kicks in again. If you take out those specific WTC and extra reinsurance charges, the international combined ratio was actually 113%. Still a loss, but indicating significant underlying improvement.
So they were making progress underneath the noise.
Definitely. They said a great deal was accomplished improving the international business, focusing on specialty products, growing underwriting profit in London through their Lloyd's syndicates.
Ah, the Lloyd's market. Big deal in global insurance.
Huge. So they were strategically strengthening their global position, even right in the middle of the storm.
Okay, let's just pause and absorb that. It really sounds like, yes, a brutal year for underwriting overall, especially with those massive 9/11 losses. But you see these clear strategic moves, focusing specialty, improving international, cutting bad business.
Right. And they were so open about the problems, weren't they? Naming the issues in North America, the WTC impact, and laying out their plans.
Yeah, that transparency is striking. And we shouldn't forget those discontinued lines. They took a huge hit. What was it, $125 million in underwriting losses? A combined ratio of 229%.
Just staggering, that 229%, completely unsustainable, and the breakdown is revealing. $39 million from motor business they just couldn't fix, another $20 million from increasing asbestos reserves.
Which shows they're still dealing with those long-tail historical issues even amidst a current crisis.
Exactly, that conservative approach again. And then another $25 million because they had trouble collecting reinsurance they were owed. Just a nightmare scenario.
Wow. So that list of losses, it's not just bad news. It's actually proof of management actively cleaning house.
Oh, I agree.
Pruning the stuff that doesn't work, facing up to old liabilities, even when it looks bad short term.
Incredible discipline to cut your losses like that, despite the immediate pain.
Yeah. That proactive stance on underwriting, cutting unprofitable lines, it feels very similar to their disciplined approach on the investment side. Tell us about that. How did they handle the markets in 2001? Because that was a notoriously tough year for investors.
It really was, and it's fascinating to see how Markel's investment side performed against that backdrop. You mentioned 2001 was difficult. The S&P 500, for example, lost almost 12%, and 11.78% lost, to be precise.
Yeah, a brutal year for equities.
Yet Markel's equity portfolio earned a total return of 16.9%.
Wait, earned? Positive 16.9%.
Positive 16.9%. And their fixed income did well too. Overall, their total investment return for the year was 8.4%.
That's incredible outperformance.
It is. And the letter hammers this point home. They measure success not by these short-term market swings, but by compounding book value per share over the long term. They cited a 22% rate over the previous 5 years, 18% over the previous 10. That's a serious track record.
Remarkable. Was that just brilliant stock picking in a terrible market? Or was it more about their core philosophy? Maybe holding a lot of cash or focusing on things that don't correlate with the main market?
Well, it's less about market timing or just pure stock picking genius, although I'm sure that helped. It's really fundamental to their investment philosophy.
Which is?
They call it a sound, common sense investment approach. Basically, value investing, owning good companies for the long haul, low turnover. They weren't glued to the news, reacting to every dip. They were looking for intrinsic value.
So market chaos is actually good for them.
In a way, yes. They explicitly say they view market volatility as an opportunity, not something to fear. It lets them buy quality businesses when they're on sale because everyone else is panicking.
Okay, but there's a wrinkle here, isn't there? You mentioned book value per share growth is their main metric. But in 2001, even though shareholders' equity went up a lot from $752 million to $1.1 billion because they raised more capital.
Right, they issued new stock.
Exactly. And that issuance actually caused book value per share to decline by 10% during the year, even though it finished the year higher than it started at $110.50 versus $102.63. How do they square that, being so transparent about short-term dilution while preaching long-term growth?
That's a fantastic point, and it really highlights their long-term focus. They were completely upfront about that dilution. Why? Because raising that capital, even by issuing stock, strengthened their balance sheet enormously.
Gave them more firepower.
Exactly, more dry powder for future investments, especially when assets were cheap. They were willing to accept that temporary dip in book value per share because they knew the added capital would fuel greater compounding down the road.
So the transparency reinforces the strategy.
Precisely. It shows they're prioritizing the long-term health and growth potential of the business, managing the portfolio first and foremost for their policyholders. That stability and growth ultimately benefits shareholders, but it's a patient game.
It really makes you think, doesn't it? How does that kind of disciplined, long-term approach, one that sees volatility as a friend, sit with your own financial thinking, especially when the markets feel crazy and every headline screams urgency? What can you take away from that mindset?
It's powerful stuff. And when you dig into the philosophy behind Markel's leadership, which this letter really lays bare, it's incredibly consistent.
How so?
Well, look at the openness about disappointments. The specific, detailed reasons for losses, the motor business, asbestos, reinsurance collections, that's real transparency and accountability.
Not trying to hide the bad news.
Not at all. They're identifying problems clearly and tackling them head on. And it reinforces those core beliefs we talked about: conservative accounting, strong reserves, not just as buzzwords, but as essential tools for resilience, especially when things get really tough.
It feels like their definition of success goes beyond just the quarterly numbers.
I think it has to. The constant drumbeat on careful underwriting, patient investing, building a robust organization, it all points to a broader idea of value, one built on a solid foundation designed to last.
It also seems like there's a deep belief that knowledge is only valuable if you actually understand it and use it.
Right. And that continuous learning and adapting are key. You see that in how they were improving the international side, how they were willing to cut lines that weren't working.
They're synthesizing information, spotting patterns, connecting dots.
Exactly. Their approach to such a difficult year demonstrates that ability clearly. It's not about pretending to have all the answers in a crisis, but about having the right framework, the right principles to navigate the uncertainty.
So pulling it all together, what's the takeaway for us? This isn't just an insurance story, is it?
Not at all. It feels more like a blueprint for navigating any really complex situation.
Yeah, it emphasizes discipline, clear communication, especially about challenges, and just sticking to that long-term view.
And seeing those challenges not just as problems to survive, but as chances to refine your strategy, to strengthen your core principles.
Imagine being in their shoes in late 2001. The world's upside down, your industry's been hammered, and you're writing to shareholders about long-term growth and conservative values. That takes real conviction.
Absolutely. Mental fortitude. The 2001 Markel Letter really shows that true resilience isn't just about weathering the storm. It's about using the storm to reinforce your foundations.
Building a framework that lets you not just endure, but adapt and maybe even thrive.
Exactly. So the question maybe to leave you with is this. What timeless financial wisdom from this incredible letter written in the eye of a storm can you apply to your own world?
Whether that's your career, your investments, maybe even personal challenges.
Right. How can you use those principles, transparency, discipline, long-term focus, to turn uncertainty into an opportunity for real growth?
A great question to ponder. Thank you so much for joining us on this deep dive.
Always a pleasure.
Keep exploring, keep learning, and we'll see you next time.